Hello everyone. India Ratings and Research has come out with its market wire titled RBI measures could alleviate pain for small borrowers and their lenders amid second COVID wave. The agency opines that the measures announced by RBI to tackle the second COVID wave would help contain the pressure on the banking system's asset quality, especially for the MSME and retail segments. The lender's willingness to support borrowers through reassessment of working capital or incremental lending could be low, but restructuring forbearance usage could see a spike, and so could delinquencies in 9 months FY22. The lenders could invoke restructuring up to September 21 and implement them up to December 21. While this could provide immediate relief to the beneficiary borrowers, this pool, along with the ECLGS beneficiary pool, could result in slippages spread over FY22 to FY25. In India Ratings estimates, banks have restructured 450 billion rupees worth of MSME loans in FY21. Non-banks, especially in the vehicle finance, mid to large ticket LAP, unsecured business loan segments, could make substantial use of these provisions. RBI has allowed small finance banks to provide incremental loans to MFIs with AUM of less than 5 billion rupees to be classified as priority sector loans. This may be of modest help given small finance banks' past disinclination to lend to such MFIs, and also given that their direct exposure to microfinance anyways stands at 60% for the 8 small finance banks with microfinance origin out of a total of 10 small finance banks. The small borrowers of these banks could materially benefit as the special long-term repo operations to be conducted for them amounts to almost 10% of the small finance bank's cumulative exposures. The countercyclical provision buffers for the public sector banks at the end of third quarter FY21 were created in FY11 to FY13 and partially utilized in FY14 and 15. These are lower than 0.1% of total advances for all banks and hence not material. RBI has also allowed deductions in incremental loans to MSME borrowers from the net demand and time liabilities for calculation of CRR. That is, the banks could keep a lower quantum of funds under CRR. Financing for the vaccine supply chain has been classified as a priority sector for the banks. Rupees 500 billion of immediate liquidity would be made available to the banks for a tenor of up to 3 years and at a rate equivalent to RBI's repo rate up to March 22. However, it should be noted that this quantum of assistance is almost equivalent to the total exposure of the banking industry to the drugs and pharma segments. The RBI will conduct a second round for the purchase of government securities under GSAP 1.0 on 20th May 21. This could aid system liquidity and it may also help ease pressure on the yields on government securities, aiding government's borrowing costs. India Ratings in its banking outlook has opined that in view of the 2 times increase in retail stress, that is retail gross non-performing assets and restructured assets, banks especially over the last 1 year have tightened the filters more so for new to bank customers and hence slowed down their disbursements. This, along with having no nationwide lockdown like last year, could prevent a comparable stress in retail assets in FY22. In case of non-banks, however, the stress and restructuring could continue to increase as regular accounts through last year could be impacted adversely for the second year in a row. That's it from our side. For any questions, please contact the investor desk. Thank you everyone.